Hi folks, in today's session we will practice how to enter a selling cover call strategy. Remember, when you want to use the cover call strategy, you buy a stock first and the stock has to be fundamentally good, the one that you want to buy and hold long term, and expecting the share price to go up, at the same time collecting dividend along the way. Now, in the long run, as you can see, stock can go up, but then in the short term it may be sideways or even slightly down, and you want to sell call option on top of the stock that you're owning so that you can get extra income. Now, ideally, when you use the cover call strategy, a rule of thumb is just use it on one of the 30 stocks inside the Dow Jones Industrial Average Index. You don't have to, but that's my preference. The reason for it, because 30 stock in Dow Jones is considered as blue chip, the one that is steady, paying good dividend, and in the long run, it should perform well. And I found one of the stocks in Dow Jones that I can use today for cover call strategy. And the stock name is Pfizer, a steady blue chip pharmaceutical company that been in the Dow Jones for a long time. If you look at the chart of Pfizer over the past 10 years, you see it's steady going up, right? Very solid, very beautiful in terms of uptrend. And you also see the dollar sign here. So along the way, every single quarter, the stock also paying dividend. So it's very consistent quarter after quarter. So that's the stock that you want to buy, holding long term, collecting dividend, and now you want to sell premium to get extra income on top. Now, if you look at the Pfizer stock price chart on the relatively short term in terms of 1 year, it's also still on the uptrend. But recently, since past 3-4 months, it has been sideways or even slightly declined, and look like it hitting some top at the 46 level here, and you don't think it's going to go through it in any time soon. So this is a perfect setup for selling cover call strategy. So criteria number 1 is one of the 30 stock in Dow Jones met. Number 2, the stock is on uptrend. Is it the case here? Number 3, short term it's slightly down or declining, and that is the right way to set up for a cover call strategy. So let's go back to the Thinkorswim platform right here and go to the trade and type Pfizer, PFE. Normally, when you choose the time frame for the trade, my preference is anywhere between 35 days to 45 days kind of thing. 35 days is like 5 weeks, and 5 weeks you enter, and then after 4 weeks you roll the call to a new 35 days. So it becomes your monthly exercise, right? So every 4 weeks you need to go back and roll the call again, and it becomes your monthly income. So that's how it works. So if you want to do that way, right? So here you can find not perfectly 35, but 39. Let's call it like 5 weeks or so. And when you sell a cover call, ideally you should sell 1 strike or 2 strikes above the current price. The reason for it, because you also want to leave some room for the stock price to go up, and you also get some capital appreciation together with dividend and the premium at the same time. Remember, cover call strategy give you 3 streams of income: capital appreciation potential, dividend that they pay, and also the premium that you collect. So the combination of the 3 streams of income will be very significant. And we do some math to calculate the return on investments for this strategy later on. So let's say you like to sell cover call for Pfizer and using the 39 series here, 39 days to expiration. Now the price of the stock is 43.3, and you may want to sell 33.5 or 44, right? Give some room for the stock price to go up, and you pocket the profit from it as well. So let's say I like to sell 44 strike, and if I have not owned yet the stock, then I can execute the order in one shot, buying 100 shares, and at the same time sell 1 contract call option against it. So both legs of the trade can be executed in one order. So I show you how to do it in the Thinkorswim platform. So on the call side here, on the DTE that you've chosen. Just click on the strike that you want to sell and you just click buy and choose cover stock. Now the system will feed an automatic order for you. It's called cover, which is cover call. You buy 100 shares of Pfizer stock. At the same time, you sell one contract Pfizer expiring on April 5th, 2019, and you sell the call at 44 strike call option, and with that you have to pay a net debit. The reason for the net debit is because you have to buy the stock, which means you have to pay some cash outlay, and then you collect premium to reduce the cash outlay for you. How much is the discount that brings to you, right? So if you look at the share price right now, that is 43.26, and with this trade you can own the stock at the lower cost at 42.65. So if you do the math right here, 42.65, if you divide it by the current market price, 43.26, that means 1.5% lower than the current market price. That's the beauty of cover call as well. It helps reduce your cost of owning the shares, and this is just for 39 days. What if you keep doing it for many rounds, 39 days, 39 days, 39 days, and eventually you bring cost of your share down significantly, and eventually it goes to zero if you do it long enough. So let's forget about it for now. Let's focus on the trade. Now, where's the 42.65 is coming from? So basically that is combination of two things: the share price, which is 43.27, and the credit that you can collect from here, about 59 or 60 cents. So that is bringing down the share price to this level. So that's the net debit of the combined buying shares and selling cover call. Now you want to look into the P&L profile to see how's your risk and reward ratio and where's your profit zone. Just right click on the trade on the panel there and analyze the trade. So now you can see the chart there. The blue line is a P&L at the expiration date. Okay, as you can see there, and if you really want to know what is your break-even point, just click on the menu here, set slices, and break even at the expiration. So your break-even price is 42.65, which is exactly that this debit that you're paying, right? Compare versus 43.26 here, you have some buffer on the downside. Even the stock price dropped by 60 cents or so, you will still be breaking even. So go back to the analyze, you see break-even point. So if by expiration date your share price closed at 42.65, you would be profitable on the trade. Okay, if it dropped below that, you would be losing money. But that is no different than owning the share and the share price also going down, and you also have that kind of risk profile. The difference is in this case you have some buffer, right? You have 60 cents buffer on the downside. Now on the other hand, if share price goes up, your profit will increase, but it will be capped at around 44. Remember, when you sell the 44 call, you are obligated to sell your share at 44 regardless how high the price can be. So said differently, when you sell cover call, you cap your upside potential of the stock. So that is a disadvantage of this strategy, but hey, that's also good because you only hit the max gain scenario, and beyond that level you will be losing out the upside potential for it, but hey, your trade is still profitable. You just need to be happy with that, because that's a dilemma of selling cover call. Yes, you will have some buffer on the downside, you can reduce your cost of owning the share, but on the other hand you also cap the upside potential. But if you believe that Pfizer stock will be moving sideways or even slightly up or slightly down, this could be a best scenario for you to do. With that, right, let's say I'm happy with this trade and I just check the market price again around 42.66, and then I just right click and confirm and send. Now the broker tells me that my max profit will be 134, which is this level, right? When the share price goes beyond 44, that will be my max profit. So the broker will block only 1,241. Ideally, it should block what? 42.65 times 100 shares, about 4,265, right? But because I'm using the margin account, the broker allows me to leverage. So it gives me some margin, so I don't have to pay the full price of 100 shares. I just pay a fraction of it. So it will improve my return on investment even further. So let's do the math here. If let's say I hit the max profit 134, and I use a capital of only 1,241 divided by 1,241, right? That would translate into about more than 10 or almost 11% return on my investment over the matter of 39 days. Okay, if you analyze it, analyze means you do 39 days back to back, right? For many times in a year, you could do the annualized return, which is divided by 39 and you time 365 days. So that would translate into about 101%. If I keep hitting the max profit, meaning the stock price keep going to my strike price and my option expire at that point in time, and I keep selling a new call option, then that could generate about 100% return on investment on the capital that the broker blocked from my account. Now, if let's say you don't have the margin account, you have to use the full cash to buy the stock. In that case, you need $4,265 in your account to own 100 shares of Pfizer. Let's say you have to use that money, then you collect $134 max profit. You divide it by 4,265. That would still give you about 3% over 39 days. And do the same math, you divide it by 39 days and you time 365, which is annualized return. That would give you still about 29-30% kind of return. Not bad if you use the cash account. So that is something you may want to consider to do. Now, there's no guarantee that you will hit the max profit every time. So let's say, forget about my stock getting to the max level. Let's say you just count the premium alone and assume the stock price will be like sideways, flat like a pancake. What this translate into. Because you collect about $60 per contract for selling a call. So let's say you only count on the premium. $60 per contract over 39 days, right? So divided by 39 days times 365, okay? If you keep doing it, so over a year you would collect $561. Now, if you have to use cash to buy this stock at this market price, you divided this one over 4,325. That would translate into about 13%. So premium alone give you about 13% per year. I'm not counting on dividend. I'm not counting on stock price potential capital gain. So premium alone give you about 12-13% per year, right? And if you count the dividend, that's another 3-3.5% on top of that. And then if you count the potential capital gain, that could be 25-30%. So that's a typical rate of return you could get if you keep selling cover call on the blue chip like Dow Jones stock, like Pfizer. Hopefully that gives you some idea on how to use cover call strategy to make money with a significant boosted return on investment for you. Okay, so go back to this trade again. So I like this trade, I locked it, and I confirm and I send it out. Done. So the trade has been filled right now, and if you go to the monitor, you see it's filled, right? So I bought 100 shares of Pfizer, right, at the market price 43.26 per share, and then at the same time I sold one contract call option at 44 strike, expiring on April 5th 2019. I collected 61 cents, and net I pay a debit of 42.65. So that actually is also my break-even point, right? By expiration date, if stock price doesn't drop below the 42.65, my trade will be profitable. If it's beyond that, I make profit. If below that, I lose out some profit. So right now, if you go to Pfizer here, click into it, and you see one trade here. I own 100 shares, quantity 100 shares, and I am short one contract, 39 days of call 44. So that's how it works. And right now the P&L for that trade is still breaking even to slight loss. I'm not worried so much about it. So, okay, we monitor it, and we come back maybe hopefully after 4 weeks and roll the call to the new 35 days and keep repeating the exercise to collect regular income for you. Hi folks, this is Friday night. It's a rolling time, you know. This is my favorite time every week. Almost every time we have like lots of short option that is going to be expired wordless on Friday, and I just need to roll it to the new term, or I just let it expire sometime. Even if it's not expired wordless, I also need to close it, or I need to roll it so that I don't have to be assigned with the underlying securities. Most of the time I don't own the securities. I just buy or sell options. So what action I need to take right now? About a month ago, I entered a cover call trade on Pfizer, one of the Dow Jones stocks. So the exact date when I entered was on 26th of Feb, cross midnight, so 25th. So today is March 30th, just cross midnight again, so 29 in US time, a little more than 4 weeks ago. And the option that I sold same time is going to be expired in 7 days. So the date to expiration is 7, meaning the next Friday is going to be expired. Now, you know my rule when I sell cover call. I open at 5 weeks date to expiration, roughly. And then after 4 weeks, I will roll it. So it become my monthly routine, monthly exercise. So it's already a month now. I need to roll it to another 35 days so that I can collect new premium for my stocks. So the time when I enter Pfizer, I paid 43.26. That is the share price at that point in time. What is the current share price? It's 42.31. So the stock has dropped about $1. So apparently I lost money on my underlying stock. But I'm not so worried because I know this is a stock that is fundamentally good and I want to buy and hold in the long run, right? So I keep holding on to my stock. Because the stock drops, that means the call option that I sold a month ago is going to be expired worthless. So rightly so, if you go to the position statement that I have, the one contract that I sold here, current market price is just 1 to 2 cents. So when I sell to open the one contract here, I sold it for 61 cents. And right now it's down to 1 to 2 cents. So I already almost maxed out 100% of the premium. So I can leave it right there. Within a week, I think this option is going to be expired worthless anyway, and it will be removed out of my position. That's one way. But hey, you have to wait for another week, and you can only squeeze out the last 1 or 2 cents. It doesn't make sense to me. So I wait no time. So I just want to roll it now so that I can get new premium as my income, and I don't have to wait for another 1 week. Okay, so I will close this one because it's almost expired worthless right now, and I'm going to sell to open the new one, perhaps at the same strike price, and collect the new set of income for my position. Here's how you roll the cover call option. Just right click on the leg that you want to roll, which is the call, and if the system doesn't allow you to roll, just create a closing order. Now you want to execute two legs at the same time. Close the current leg and then open the new one. So if you just close this one, this is one shot, and I want to do two legs at the same time. So instead of just close one single call, I will then look for a new call option to sell. Another 35 days from now, which is May 3rd here, I can find 35 days. And perhaps I choose the same strike price, which is the 44 strike price. So I hold the control key and I sell, which is in the bid column, right, at 44. Now you can see that I'm having one rolling order, which is to buy to close the current call option, which is expiring next Friday, April 5th, at 44 strike price. At the same time, I'm going to sell one call option expiring May 3rd, which is 35 days from today. Same strike price at 44. And by doing two legs together at the same time, I can collect a new premium, which is a net credit between the one I am selling to open and the one I'm buying to close today. So 31 cents is a new premium that I will collect today if I execute this. Because it's the same strike price, it's just different timing. The system interprets it as a calendar spread. So forget about what's the name, but importantly, you need to know what you are doing here. So if I'm doing it, I will just roll the current call, same strike price, 4 weeks out from April 5th to May 3rd. And then I just wait again. I hope my stop price will go up and hit my strike price. But if it doesn't, guess what? The 44 call 4 or 5 weeks from now will be expired worthless again. I keep doing it. Eventually, I collect enough credit premium that will reduce my cost of owning my shares substantially, or even for free at the end. So I'm happy with that. I just execute and send. So it's in working order here. Forget about the other order I have, right? So it's working 31, and it should be filled anytime soon. Now, since it's rather late in the midnight, I just want to get my order filled. I just reduce the credit to 30. See how it goes. Yeah, so now it's filled. And you can see here, I bought my existing call option at 3 cents. And I sell to open the new one, the one that expires 5 weeks from now. And I collect 33 cents from there. So net, I collect 30 cents. Alright, so after I have rolled the option, what do you see here? So in my position statement, you see the call option that are going to expire next Friday. The quantity is showing 0. That means I have closed it completely. So tomorrow it will be removed from my portfolio statement. In exchange for it, I have another new short call, -1, so one call contract that I sold expiring in 35 days. So after today, you will see that I will continue to have 100 shares, which I hold for long term. And I also have one short call option expiring in 35 days. So in 4 weeks time, I will continue to do the same exercise that I just did today. So let's summarize the trade. So that is a cover call on Pfizer. I entered the trade on 25th of Feb, and today, 29th of March, I just rolled it because after like a month, right? And that means after 32 days, so it's a monthly exercise. I enter with one contract, meaning I bought 100 shares and I sold one call option against 100 shares. And at the entry point, I enter with two legs. Leg number 1, I bought the share at the $3.25 per share. And at the same time, I sold a call option and collected 61 cents per share. So net my cost is 42.64. Now, today I just roll it and I collect another net credit 30 cents for the net of the two legs. So I bought to close the existing call, I paid 3 cents per share, and at the same time I sold to open the new one expiring in 5 weeks, and I collected 33 cents. So net I collected net 30 cents per share, so $30 for one contract. So current share price as of today is 42.3. Apparently it's a drop versus the time I bought the share. So when I bought the share at 43.25, now it's 42.3. So the share price dropped 95 cents. So that means on the share, I have an unrealized loss of 95 cents. At the same time, I collected $61 from selling the first call option. So I reduced my loss to around 34. Not bad at all. So remember, if you just buy and hold the stock on a long term and the stock drop, you can lose on the stock. But if you keep selling cover call against it, you reduce the loss significantly. Now, in the next 4 weeks, I am very hopeful that I can make this 30 cents net or the 33 cents for the new one to be expired worthless again. So that means I essentially wiped out of my loss. So in a month time, if the share price stays right at the current level, I will break even. But if it goes up to 44, man, I will make a lot of profit because of capital gain on top of premium I collected. So hopefully that gives you some idea of if you already own a stock for long-term holding anyway, selling call options to collect extra income while you're waiting for your stock to go up. And along the way, you can also collect your dividend.